Hi, everyone. Thanks so much for joining us today. My name is Kelly. I'm the manager of the success team at Next Chapter. And today I'm joined by Josh from the Student Loan Toolbox, and he's going to talk a little bit about the IDR account adjustment and how it can speed up forgiveness for federal student loan borrowers. So before we get started, we do have a few housekeeping items. We'll post some relevant information in the chat, so mostly about links for upcoming sessions and then any dates that we have coming up. We're also going to provide a pre-registration link for our Bankruptcy Week. So Bankruptcy Week is a virtual conference that we hosted a couple years ago, and it just has a lot of relevant sessions for bankruptcy attorneys and any information that they've found interesting and relevant to them. So we're hoping to host another one later this year. And so we're going to post a link for that. So if you do pre-register, you'll get all of the intel beforehand so you can get early registration and information on any upcoming sessions. So be sure to register for that. We're also going to provide a promo code that offers 10% off the Student Loan Law Workshop with Student Loan Toolbox. So our partners that are co-hosting this symposium, obviously Josh with the Student Loan Toolbox, and it will be applicable to both the attorney and paralegal tickets. And then lastly, I will provide a sign-up link to get started with your free Next Chapter account. So if you don't already have one and you sign up for one of these sessions, which if you're in the session, you already have, and you pre-register for our Bankruptcy Week, you will get a free case with Next Chapter. So be on the lookout for those links. I'll post those just when I hop off here and invite Josh back on. And then lastly, if you do have any questions throughout this session, you can send them in the Q&A feature. Josh does a really good job of answering them as he sees them come in, but if we don't get to them right away, we will definitely have a session at the end for any that are unanswered. So, okay, I'm going to hop off here and let Josh join.
All right. Hello, everybody. I'm not going to use my camera because I don't want to distract you from the importance of the slides. And you will be getting a copy of these when we're done. So what I want to talk about for the next hour or so is the IDR Account Adjustment. And this is something that actually started back in November. And it is not widely publicized. It is not affected by the Supreme Court's decision whenever that happens. It has nothing to do with the Biden $10,000 or $20,000 forgiveness. This is all about income-driven repayment. It can't really be undone because IDR is a law and the Department of Ed is merely promulgating that law. So it is what it is. So let's get into that. Now, hopefully you were either in the webinar earlier today where I did student loan basics, or you've got a rough idea of some of the stuff I'll be talking about to understand the deeper granular stuff. I want to talk about repayment plans, and we'll start with all of the repayment plans and then explain how the IDR account adjustment works into it. But we're also going to talk about PSLF because public service loan forgiveness ties into the account adjustment that you're going to see. Someone wants to know if I've seen anyone get it yet. The answer is maybe. I have one client, we're not sure if that's what it was or if there was something else going on. But I do know the PSLF forgiveness is happening, and I know the borrower defense to repayment is happening. Things are heating up for the IDR account adjustment, and we should start seeing forgivenesses in bulk or in mass very soon. All right, so let's talk about repayment plans in general, okay? There are 4 of them that are based on amortization. It's exactly what you expect. You buy a car, you have a payment, you pay the car, you pay the payment, you get to keep the car. And so the first one is the 10-year standard repayment. It is a 10-year amortization. Very simple. You borrow a loan, you pay it off in 10 years. And then there is the graduated payment plan, which is still a 10-year amortization, but it is in increments. It starts at a lower payment and every 2 years it steps up. Okay, not a bad deal. If your balance is over 30,000, they give you the extended 25-year payment plan, which is a 25-year amortization. And if you really need help, they have the extended graduated plan, which is a 25-year amortization that starts low and every 2 years steps up. You've heard me say this before. I'll keep saying it. This is perfect. We work for 25 years. We get a raise every 2 years. If you're not getting a raise every 2 years, talk to your boss. If you're self-employed, that's going to be an interesting conversation. So let's dive into the income-driven repayment plans, or IDR. Student loans is alphabet soup. And the more you can use those acronyms like you do with bankruptcy, the smarter you sound. And when you sound smart, people are happy to hire you. So let's get into our alphabet soup. We have IDR, income-driven repayment plan. The first one that came out was income contingent repayment. This has been around since 1993. I don't know many people that have been on it since 1993, but it's been around since then. This is based on both the borrower's income and the loan balance. It has a 20% formula. I'm going to show you the formula. I'll give you a peek behind the curtain in just a minute. But this is a 20% formula. We care about income contingent because it's the only plan available for parent plus loan. The next one that came around that just exploded, made everything more popular, is income-based repayment, IDR. This is based only on income, and family size plays into this. And it's a 15% formula. It is usually better than ICR. There are some circumstances where ICR comes out better, but for the most part, income-based repayment is friendlier. And it is also the only plan that is available for FFEL loans. Remember, an FFEL loan is a loan not originated by the Department of Education. It could be from anybody else, private bank or a guarantee agency, but not Ed. All right, and then we have Pay. Pay came out in 2012 through executive action. It's the same as IDR, but slightly better formula. It has a 10% formula instead of 15%. However, it's got a catch. You can have IDR if there was a balance on your loan as of October 1st, 2007, and you needed to take a new loan after October 1st, 2011. You cannot simply consolidate and say, oh, look, I have no balance as of October 1st, 2007. It doesn't work that way. If you owed a penny on October 1st, 2007, you're not eligible for Pay. This was made for the class of 2012 and newer. Okay, so if you want to ask, well, why do people do IDR when they can do Pay? Because they probably can't, because of the date restriction. All right, and then there's new IDR. New IDR is law. It came out in 2014. It was enacted in 2014, I should say. It was actually written before that. It's what Pay is based on. But because new IDR wasn't enacted till 2014, the Obama administration, through executive action, created Pay. So new IDR, again, is the same formula. It's a 10% formula. But here, the date restriction is no balance as of July 1st, 2014. This is for the class of 2018 and newer. So again, why aren't people on new IDR instead of old IDR? Because of the date. Okay. And the last payment plan to discuss is Repay, revised Pay as you want. President Obama was not happy with the date restrictions on Pay. So they went back to the drawing board and they created Repay. This has no date restriction. It's the same formula. It's a 10% formula, but has no date restriction. So now I can have it even though my loans are from the 90s. However, as the Department of Education so often does, they've got to screw the client in some way. And here they did it with the marriage. With all of the plans, it is based on adjusted gross income. In fact, let's get into this one. The formula starts with adjusted gross income, AGI, adjusted gross income from the 1040. All right. Now, if the borrower is single, then it's just their AGI. If the borrower is married, then it's a question of, do they file married filing separate or married filing jointly? If they file jointly, then their joint AGI gets used. If they file separately, then their separate AGI is used. So if only the husband has loans and files separately, then we use just the husband's income, except for repay. When it comes to repay, they still use both spouses' income. Now, many of you, you've been in bankruptcy and you've seen it all. You've probably seen those couples where they barely know what the other one does for a living. They certainly don't know where they bank. They have no idea how much their income is or what's in their bank account or what their car payment is. And they somehow share their expenses and everything works. That's probably why they're happily married, you know. If it is not feasible, if the borrower is unable to reasonably obtain spouse's income information, there is a box they can check on the form, on the application. And if they check that box, then they are treated as a single person. So it means, and this is weird, I don't know how maybe they filed taxes jointly, but they don't really share, or maybe they've become separated since then or something. If something changed, then they can check that box. And then they don't use their AGI from the joint filing. They'll use something else, such as pay stubs or a self-certifying letter that says, hi, my name is Josh Cohen, I'm an attorney, and for the month of January, my income was $5,000. They'll take that 5,000 multiplied by 12 and say, okay, Josh, you make 60,000 a year. Here's your payment. So there are ways to finesse a little bit. You can't do any of that during a 13. You should have everything. But outside of a 13, there are some ways. But the bottom line is, if they do file jointly, that may work against them. It's a case-by-case issue. But they start with adjusted gross income. So we start with AGI. We subtract the percentage of poverty index. So poverty index looks at the family size. And when we look at family size, are you married? Okay, you've got a spouse. Do you have children? When they count children, they want to know how many children the borrower supports at least half time. Support is not just income. Support is wide open. Do you go to their baseball games and to their Girl Scout activities and their ballet recitals? And do you show up and do you give them a hug every morning? It's that, okay? This is not a place where the stay-at-home mom loses out because she doesn't contribute income. I would never tell a stay-at-home parent that, oh, you don't really contribute. That's not true. We all know what they do at home. So if they support that kid at least half time, yes, they get to count. It means if you have a divorced couple and you have a non-custodial parent, they can still count their kids between child support and their visitation and other things that they do. They can still count them. It has nothing to do with how the taxes are filed or how many kids they claim for tax credit. Okay? So if you got a divorced father who is non-custody but sees them on weekends and they've got 3 kids, he can claim all 3 if he believes that he supports them all at least half time, be it monetary or being there and present and whatever it is. Now, some of you are asking, well, what if they're divorced? How can both parents claim they support them at least half time? Because that means you get 102% and you can't have more than 100%. The answer is the Department of Education does not do an audit of that. If ex-husband and ex-wife both believe that they support those 3 kids at least half time, they can both put 3. The Department of Ed doesn't match and go, wait a minute, you guys have the same kids. What if you lied? They don't do that. Okay, so don't get hung up on that. And by the way, as an attorney helping them, you don't sign the forms anywhere, so nobody knows that you're involved. There's no trustee that's looking over their shoulder wondering what you're doing. Okay, nor are you going to make up children. They have 3 kids, you put in 3. That's it. Now, children, actually goes further than those born. It includes in utero. And so my favorite question, well, what if I'm having twins? Then you put a 2. Do I need to send them a copy of my clear blue result? Please don't do that. Nobody wants to see that. Keep it for the baby book. Okay. But the point is, it is in utero through. Now, what counts as a child versus an adult? So children don't have to live with the parent, but they do have to be supported. But the age of cutoff is 22. If they're done with college, or whether they went to college or not, over the age of 22 doesn't count as a child. At that point, they're an adult. So the other component of family size is, are there any other folks, any other people living with you that you support at least half time? This means your 30-year-old son sleeping on your couch. It means your ex-college roommate who's going through a divorce sleeping on your couch. It could be your in-laws that are living with you. Anything that's not a child or your spouse would go into that other one. And all of that family size, then you look at the poverty index for a family of that size. Well, you don't have to do that. There are calculators that do this. Okay, so it's AGI minus the percentage of poverty. And the percentage is this. For ICR, they look at 100% of the poverty index. For all of the others, IDR through Repay, they take 150% of the poverty index. So poverty index is always better with everything but ICR. All the other plans are better than ICR because it's 150. Awesome. That equals discretionary income. We then take discretionary income and multiply it by the percent formula. Again, so it's 20% formula for ICR, 15% formula for IDR, and 10% for the others, pay, new IDR, and repay. So repay and pay are always cheaper than IDR. You divide that by 12 and you get the monthly payment. This is where you can have people have a $0 payment. Okay, for family size, can you claim parents who live in the basement, but they file their own taxes so I don't claim them as dependents? Again, tax returns have nothing to do with it. Get your head out of the bankruptcy game. We're in student loan part. It has nothing to do with taxes. They live in your basement. Do you support them? Do they pay rent or are you covering their rent? Do you cover their food bill at all? I mean, how much are they contributing and how much are you supporting them? If you believe you're supporting them at least half time, then yes, you can count your parents living in the basement. All right, so again, income contingent is AGI minus 100% of poverty index times 20%. IDR is AGI minus 150% of poverty index times 15%. So it's cheaper because the poverty index is larger and you take less of that discretionary income. New IDR, pay and repay, is 150% of poverty index, like IDR, but they only want 10% of what's left in. So this is a winner. So if you can be on repay, be on repay. But again, if you have an FFEL, you're stuck with IDR. Consolidate, you could have repay. Okay. Again, it's possible to have a negative amortization where your payment doesn't even cover interest. That's okay. You can have a payment as low as 0. That's okay, because again, bullet 4, the balance of the loan that remains after 20 to 25 years is forgiven. No, they don't want your social security number for any of them. They don't ask for proof. If you've got 4 kids, put down the 4. They don't ask for anything. Okay, balance of the loan remaining after 20 to 25 years is forgiven. Now, a 1099-C is supposed to be issued, which might have tax consequences. However, there are no tax consequences for any student loan discharge or compromise or settlement through December 31st of 2025 because of the American Rescue Act. So it's not just bankruptcy discharges that are tax-free. IDR discharges are tax-free. PSLF discharges are tax-free. A private student loan settlement is tax-free through December 31st, 2025. Woohoo! That saves some money. So, all right, what happens after in 2026? Hopefully Congress wakes up and makes it non-taxable. The IDR forgiveness, good question, Greg. The IDR forgiveness is automatic. So when you hit it, give another 60 days and done, gone. Okay, so it doesn't matter what your adjustment comes out to as far as the taxability. It matters when do you get full forgiveness. If you get full forgiveness on or before December 31st, 2025, it's non-taxable. If it's January 1st, 2026, sorry, you're getting a 1099. By the way, I don't know that it's taxable. I just know you're getting a 1099. Your accountant is the one who's going to tell you if it's taxable. There are lots of ways it may not be taxable. All right. And again, you have to recertify the income every 12 months. So, and again, Jessica, they don't ask for proof of family size, no social security numbers or anything like that. Again, parent plus loans are stuck with income contingent repayment if it's inside a direct consolidation loan. Perkins loans can have any IDR if it's inside a consolidation. Essentially, if the Perkins loan is with the school, they don't have IDR. If you consolidate it, take it away from the school, they can have ID. All right. So again, here's a sample chart. I like a couple of two, a family of two with $100,000 income. So if both husband and wife have student loans and their combined income is $100,000, their combined household payment is $960. They will divide that $960 pro rata. Okay. If they pop out two kids and now they're a family of four, their payment drops to $800. And again, it's still going to be pro rata. If only one of them owes, then they owe that whole payment. Okay. Notice how this is based on household income and the number in the household. Nowhere here do I mention how much they owe. You can have an IDR payment or any of these payments if it is cheaper than the regular standard payment. To which I say, duh. If you can pay your loan off in 10 years, wouldn't you? Yes. If you can't pay it off in 10 or 20 years, or whatever the payment plan is, you can have an IDR, which will get you forgiveness. All right. Repay is the only one where that doesn't matter. Repay can be more than the 10-year payment. Okay. Now, some people ask at this point, well, what happens if I get a substantial raise and I make more than I'm allowed for IBR? Once you're in IBR, you're in IBR. You can't really be kicked out unless you don't recertify your income. So if you do happen to brush up against that cap, then you're at that cap. But you don't just magically get cut off. Household income is AGI, adjusted gross income from the tax return. Unless you're not using your tax return, then it's gross income. If you don't use your tax return, you don't get any tax credits or any of those write-offs. The only write-off we get for gross, and when we say gross, we mean your personal gross, not business gross. So here's the example, Nancy. Good question. If I'm a self-employed attorney, oh wait, I am a self-employed attorney. I can either use the AGI on my tax return, or I can use my gross income for any particular month in the past 90 days. So let's say I want to use January. I'm not looking at the gross income of my law firm. I'm looking at my gross after law firm expenses. And if my personal gross or the firm's net, because it's a pass-through entity, if the net is $5,000 after business expenses, after rent and my paralegal's salary and medical malpractice insurance and whatever other fees that I write off, if I'm left with $5,000, then that's what I report. They'll multiply it by 12 and say you make $60,000 a year. So it's AGI if you use your tax returns, or gross income if you don't use tax returns. If you use a pay stub, then they're going to use your gross for that pay stub and multiply it times how many times you get paid. They're not going to take out FICA and taxes and Social Security. So that is the risk of not using a tax return. You don't get any of those right. But there are other reasons you use. Okay, this IBR chart has nothing to do with your loan balance. So you're on IBR and then your kid goes to college and you take a plus loan. Guess what? It doesn't affect your IBR payment. It's based on your income, not your loan balance. However, your new Parent Plus loan is not on IDR because it can't have it. So you're going to need to consolidate that and put it on ICR. Here's another point there. Thanks for that question. If you have Parent Plus loans and non-Parent Plus loans, and they're in separate spots, if you put your Parent Plus loan into one consolidation and all the others are somewhere else, the Parent Plus consolidation gets ICR. The other ones can have repay, and they offset each other. It's not a double dip. That's a little more complicated. You're welcome to ask me offline. So here again, you're going to get a copy of these slides. Here is your cheat sheet. All of the different plans, the term to forgiveness, ICR and IDR get a 25-year forgiveness, pay and new IDR get 20. And then repay is a 20-year forgiveness if you only have undergraduate loans, 25 years if you have a single graduate level loan or more. The formulas, 20, 15, or 10. Any of these are available for direct loans. Only IDR is for FFEL loans. Parent Plus loans can only have ICR if it's inside a direct consolidation loan. And again, you can ignore the spouse's AGI if you are married filing separate status, or you can check that box that says unable to reasonably obtain spouse's income information if that's the truth. Okay, now let's talk about the IDR account adjustment. So before I get there, so if you're on an IDR, let's say you started your loans in 2008. Okay. Let's say you're me. You finished law school in 2007. So you started paying in 2007 while studying for the bar. That was fun. I signed up for IDR in 2009 when it rolled out. So I've been getting IDR since 2009. I have an FFEL loan. Well, 2009 to 2023 is, I know we don't like math, 14 years. I have 14 years on IDR. If I want to switch to repay, I need to consolidate. If I consolidate, I lose those 14 years. I'm starting from scratch. So the question for me, if I'm a client, can you afford IDR for 10 more years and be done? Or is repay so much more cheaper that you want to be on repay and you'll have 25 years to go? What if I didn't have graduate loans? Well, then I only have 20 years to go. So it's 10 years if I stay on IDR or 20 for the repay. It's all math. You guys are bankruptcy attorneys, you know math. It's going to be case by case. If a client comes in and they've been on IDR for 3 years, okay, I'll switch them to repay. You're going to lose those 3 years, but you'll make it up in the money that you're saving. And if they come to me with only undergraduate loans, guess what? They lost 3 years, but they only have 20 years to go. I saved them 2 years. So consolidation does reset IDR. But let's talk about this magical thing called IDR Account Adjustment. What this does, it gives someone credit for all payments they made, even if it wasn't an income-driven repayment plan. They will get credit for all forbearances they've had if they either had at least one 12-month consecutive forbearance or they've had 36 months cumulative forbearance time over the life of their loans. It doesn't matter if it's an FFEL or a direct loan. If they're on IDR for 25 years, their FFEL is forgiven, period. Okay. IDR is FFEL is always 25 years. It's all on that chart. It's based on the payment plan. Okay. So with IDR account adjustment, you will get credit for all of your forbearance time. You will get credit for any deferment you took before 2013, so long as it wasn't an in-school or that grace period you get right after school. However, military and economic hardship will count no matter when it was, even if it's after 2013. So military, they're finally getting the break they deserve. If they are deployed and they have a 3 or a 4 year military deferment and they're not making payments, they will get credit towards IDR forgiveness. Okay, that's good. So again, you will get payments for any payment plan, yada, yada, yada. What you don't get credit for is any time that you've been in default, or this is important for you folks. Anytime that you've had a bankruptcy forbearance, so if they're in a Chapter 13, 5 years, they don't get credit for those 5 years unless you specifically had language to allow for an IDR payment and they were making the IDR payment. Okay, Greg, I'm not done yet. Put that question away. I'm not done yet. Okay, so if you were smart and you know how to get your client onto an IDR during the 13, then they will get credit for those payments. This is only available for direct loans. So if they have an FFEL, you have to consolidate it. I know I just said, as Greg pointed out, that consolidation resets it. Not on the IDR account adjustment. Okay. The IDR account adjustment, I'm about to answer this question. Here's the deal. If you only have undergraduate level loans, you only need 20 years of credit. It doesn't matter what the past was. It doesn't matter what payment plan you were on. You only need 20 years of credit under the IDR account adjustment. If you have any graduate level loans, you need 25 years of credit. If you have only Parent Plus loans, you need 25 years of credit. Now, here's a funny hook. If you happen to have Parent Plus loans and only undergraduate loans, and you put them together, which normally I don't advise, but here I do, then the whole loan gets undergraduate credit, gets the undergraduate requirement, and they only need 20 years. Now, someone wants to know how far back do they go? They go back for all the time you were not in school, irrelevant if IDR was available or not. So I'm going to use me as an example. Again, I got out of law school in 2007. I started IDR in 2009 when it rolled out. IDR is a 25-year plan. That means I get forgiveness in 2034. However, under this plan, I get credit for everything. I finished undergrad in 1996. I was paying my loan. And I paid it until 2002 when I went to school for an MBA. And from the MBA, I rolled into law school. So from 2002 to 2007, I was not paying. I had an in-school deferment. Okay, so that won't count. But after, when I graduated in 2007 until now, 2023, I get credit for all of that, for the forbearances, for my payments, whether I was an IDR or not. So from 2007 to 23 is 16 years. From 96 to 2002 is 6 years. I get those 6 years plus the 16. I get 22 years of credit if they're all wrapped together. The whole portfolio gets the oldest loan credit, 22 years. If my undergraduate loans are not consolidated with my graduate loans, then only my undergraduates will have 22 years of credit. My grad loans will still only have 16 years. So I wrap them all together. You got to wrap them by July. Okay, so you got to wrap them. Now, if after the IDR account adjustment, like me, so now I'm getting 22 years of credit, I have 3 years to go because I went to law school, I have graduate level loans, I need 25. In order to get the remaining 3 years, I must stay on an IDR, even if it's more expensive than the standard plan. But that's okay because I'm going to get rid of my loans in 3 years on a more expensive plan than instead of 10 years on the standard. You must be on an IDR. So when talking about Parent Plus loans and other loans, if you want to wrap them together, the Parent Plus loan is stuck on an ICR. But the question is, how close are they to forgiveness? 1, 2, 3 years or 10 years? You have to do math. I am happy to help you and your clients with this. I'm happy to train you on how to do this in my workshop. Isn't this fun? Now, here's a very important slide. This counts again for time prior to the consolidation. This is the only time they're doing it. It is only for direct loans. If you have an FFEL, you must start the consolidation process by May 1st, 2023. Okay. If you have an FFEL, you have got to submit the IDR. You have to submit the consolidation paperwork by May 1st, 2023. If your client has an FFEL, they've got to start the consolidation by May 1st, 2023. It's March 1st. They've got 2 months. The IDR account adjustment is automatic, Nancy. There's nothing for you to do. Once you have a direct loan, they will start it. If you already have direct loans, they've already started. But if you want to do the consolidation like I spoke about, maybe you have all direct loans, but you want to consolidate them so the whole portfolio is together, you got to do, for direct loans, you got to do it by July 1st. But if you're converting an FFEL, you must do it by May 1st. I can't stress this enough. You've got 60 days to get on your client's butt and get them to do this. This might be a problem if they're in an active Chapter 13. Are you allowed to consolidate during a 13? These are rhetorical questions for you to figure out. And if you do, it's a post-petition debt. So this is going to mess with the DOJ process. Bring that question tomorrow when we talk about the attestation. You're going to have to measure which way is it. Okay. How do you review it? Look at your NSLDS, look at your studentaid.gov and see. Don't count your default time. Count any time you're not in school. That's not a grace period. Count your repayments. Count your forbearance if you've got at least 36 months worth. Count your deferment before 2013. You want a second opinion? You know where to find me. It's at the end of this slide. At the end of this slide. The clearinghouse, Lucy, is at studentaid.gov, but only your client is allowed to log in. You can't under the Stop Act. It's illegal. I don't know that Ed's going to prosecute you. Let's not find out. Okay. You've got to consolidate your FFEL by May 1st. You have to start the process by May 1st. And by start the process, I mean, it's got to be submitted. Not they walk in your door on May 1st. All right. Oh, we've got the questions bubbling. Okay, yes, anonymous number one. If you have a client that has a 1995 FFEL and they've been paying, as long as they don't have any default time, then, and it's only the default time that doesn't count. If they've got 20 or 25 years, depending on grad or ungrad, and they consolidate right now, they will get automatic forgiveness as soon as that count is completed. Here's the secret. The Department of Ed is trying to get rid of all of these forgivenesses before repayment starts in August. So anybody who's going to get their 20 or 25 year credit and have full forgiveness, they will be notified by July 1st. So they're out of the system. All of us that still have time, we're not notified until after July 1st because we're going to have payments anyway. They want all of these forgiven people out of the system by August. All right, what's this next question? Okay. I'm not quite understanding this. Someone has a consolidation from 2004, then there's only 6 years left before auto adjustment, if I understand it. It has nothing to do with when they consolidated. It has to do with how long have they been out of school and not in default. It's not about just their last loan. So they consolidated in 2004, but when did they graduate? Did they graduate in 2004? Did they graduate in 2000? Did they graduate in 97? That's the question. They're going to lose any time they were in bankruptcy, the 6 months for a 7, the 5 years in a 13. If they converted, they still lose whatever time they were in that 13, unless they were on an IDR plan through that 13. But there's no other way to get it. So back to that question, if they graduated in 99, figure they got credit from at least 2000. If they only have undergraduate loans, they're going to get forgiveness. If they're graduate, then they don't get forgiveness till 2025. But that's still a whole lot better than where they thought they were, right? All right. Again, one last time. FFEL, you got to start the consolidation process by May 1st, 2023. Let's talk about public service loan forgiveness. Am I excited? Yes, I'm excited because this is exciting stuff. Public service loan forgiveness, again, very quickly. You have to have a qualifying employer, which is government or nonprofit, and you have to be full-time, which is at least 30 hours a week, or whatever HR says it is. It's HR stuff. Direct loans only, and you've got to have made 10-year, either on the 10-year standard payment or any IDR. You need 120 months of this since October of 2007. And then you apply for PSLF. I'm going to get Jessica's question real quick. They graduated in 2007, but then they went back for another degree and then graduated in 2015. The forgiveness counts from the oldest loan if they're all consolidated together. If they're not consolidated, then each independent loan counts from when it has been in repayment. So for someone like that, Jessica, you want them to consolidate so that the 2014 loans get credit as if they've been paid since '07. All right. But let's talk about PSLF and the IDR account adjustment. Well, I've got some funkiness going on here. The IDR account adjustment applies towards public service loan forgiveness. Any credit that the borrower receives for the IDR forgiveness will also count towards PSLF forgiveness so long as they had qualifying employment during that time. They'll only go back to October '07 for PSLF. So if you have someone that's been working for the Red Cross since October of '07, but they had an FFEL loan, consolidate them by May 1st this year, and they'll get all that credit towards IDR, and it can roll over and apply towards PSLF. And as long as they're still working a nonprofit job, they can have PSLF. PSLF, you must still be working a qualifying job in order to get it. If you do your 10 years and then say, okay, I'm done and leave, you don't get your forgiveness. You have to do your 10 years of time and then another 60 days worth while they process the application. Don't quit early. But again, in a chapter 13, they're not getting time towards PSLF unless they are in an IDR payment plan. All right, and just real quick, some PSLF 2023 changes that are coming as of July 1st, 2023. And one significant change, they don't care what HR defines you as. If you work 30 hours a week, you qualify. Even if HR says, well, that's only part-time. Irrelevant. If you do 30 hours a week, that's fine. If you have multiple jobs that add up, multiple qualifying jobs that add up to 30 hours a week, that works. If you have clients that are adjunct professors, they get a factoring of 3.35 hours for every credit hour taught. Because normally the school will say, well, they only teach for 9 credit hours, so we're only giving them 9 hours of time. Now they get 3.35, which gives them over the 30 hours a week. For those of you in Texas and California, pay attention. Contractors that by law cannot be employed as a W-2 employee for a qualified employer can get credit. So apparently doctors in Texas and California are not allowed to be W-2 employees of hospitals. They have to be contract. If they are a contractor for a qualifying hospital as a doctor in Texas and California, they will receive credit. I don't know any other examples. Okay. Again, credit during military deferment for PSLF. So again, those deployed boys, girls, whomever, they're out there for 3.5 years. I understand that's a standard deployment. They're going to get credit for those 3.5 years while they're deployed, even though they're not making their IDR payments. We're going to give them the thanks they deserve. Okay. Here's the biggest. There is now the ability, starting July 1st, the ability to make up payments from the time that was not counted. So if you have a client that was in a 13 and they weren't making IDR payments, you could, after July 1st, you could petition to do this, pay the difference between what the 13 plan payment was and what IDR would have been. Let's say your plan payment was $100 a month on the loan, but had you been in IDR, it would have been $200. If you pay, for every $100 you pay, you could make up a month. If you drop a check for $6,000 on Department of Ed, you get all 60 months back. Let's reverse that. What if your plan payment was $100 a month, but had you been in IDR, it would have been only $50 a month. You can petition to have all of those plan payments count because they exceeded what IDR would have been. Now you don't even have to make up a payment, but you get credit for it. That's coming after July 1st. We don't know what the official procedure is, but we believe that when it happens, I'll know, and I'll be disseminating that among bankruptcy attorneys. This is life-changing. What about the new IDR that was talked about 2 weeks ago? And then I'm going to field more questions. There was a new IDR plan announced, it must be like 3 weeks ago. And they're calling it, I'm calling it Repay version 2.0, because it's not a new plan. Instead, they are revising Repay. But I don't want to call it re-repay. because that's just weird. It's not revised, pay as you earn. I'm calling it 2.0. Here's what's new about it. Now, this is going through negotiated rulemaking right now. A lot of it could change, but here's how it looks right now. Number one, instead of 150% of poverty index, they're going to use 225%. That's huge. That means a family of 4 earning about $50,000 a year will have a $0 payment. That is whoppingly huge. Massive. They also got rid of the marriage penalty for repay. You can file as married filing separately and avoid the spouse's income. So that's a big thing. Also, there are new formulas. Undergraduate loans will be computed as 5% of that discretionary income. So it's going to be AGI minus 225% of the poverty index. And for undergraduate loans, they'll only want 5% of that. Divided by 12 is that's your payment. Graduate loans will still be at 10%. If they have a consolidation loan that has graduate and undergrad, it's going to be a weighted average. I have no idea how Ed's going to figure this out, but God bless. Okay, so that's big change. And new forgiveness time. If their undergraduate loans were originally $12,000 or less, they get forgiveness after 10 years. For every $1,000 above 12 years, above $12,000 original loan balance for undergrad, add a year towards forgiveness to a maximum of 20 years. So at most, it'll take 20 years to forgive your undergraduate loans. But if your origination was between 12 and 18, you will get it forgiven quicker, anywhere between 10 to 20 years. Graduates, we're still stuck, 25 years. This is huge. You're going to drop the payment and you're going to get rid of it faster. Now, if it's consolidated, they're not going to bifurcate and say, oh, your undergrads are forgiven early, but your grads aren't. It's stuck. Is this a reason not to consolidate? I don't think so. I just don't think so. But we will see how it plays out. There's also rumor that they're going to phase out pay and just phase everybody into repay version 2.0. There is discussion of if they're going to allow Parent Plus loans to be eligible for this. Right now, they're not, but we will see. By the way, if I want to make it clear, the IDR account adjustment does apply to Parent Plus loans. And the retroactive, how that IDR account adjustment applies to Parent Plus loans, will also apply to PSLF for those Parent Plus loans. So if mom has a Parent Plus loan and has been working at the Red Cross since 2007, now, if she rolls them over, if she consolidates for a direct loan, she will get the recount and hopefully count it all towards PSLF. Or if she doesn't have the full 10 years, now she only needs a few more years under ICF. The point is, Parent Plus loans get covered by this IDR penalty. Everything counts. If you wrap a Perkins loan into it, they will get folded in with whatever other loans and get forgiveness based on those other loans. Okay, this is huge. Absolutely huge. It is speeding up the clock because under the current plans, IBR wouldn't get forgiveness till 2034. Pay would get it in 2032. New IBR would get it in 2034. It accelerated everybody up. And I've done my math and I am 3 years away. And I'm so happy because in 3 years, I send my first kid to college. Okay. That's about it. I think I covered everything. What other questions? What scenarios do you have or you're concerned about? Again, if you want to look at your own as a test for your clients, go to studentaid.gov, pull up your report. It's called the My Data Download, and it is an unformatted garbage dump. My software will translate it. Stretto also does software, they'll translate it. And we put it into a format that's easy to read. And from there, you can see how many forbearances you've had, how many deferments you've had, how many repayments you've made, all of that. It is automatically calculated for current direct loan borrowers, but we don't see that, Sarah. Only Department of Ed does. And we're not going to know about the recount until after July 1st if you don't get full forgiveness yet. If you get the full forgiveness, you'll be notified before July 1st. If you still have time, you will be told after July 1st. And by the way, Department of Ed is working on making a portal where you'll be able to log in and see how many IDR payments have you made so you can watch the clock tick down. They're already started at the PSLF. Mohila does that, but they're doing this for all of us. I don't know if they're going to get it up and running because now there's a crunch on budget, but that is their plan. If you need any help with this, I'm happy to help you. If you don't have any student loans, you don't get PSLF. DJ, I think you're screwing with me there. I don't know what your question is. All right. So, again, it's just magic. But again, the highlight, FFEL, you've got to consolidate by May 1st. What if you've got a client that you're about to file a bankruptcy for? Maybe do the consolidation first. If they can wait, consolidations are moving, I'm seeing within 45 to 60 days. If you can hold off on filing to get that consolidation done, then they walk in with the direct loan and they get the IDR count. And by the way, your argument to allow IDR during a Chapter 13 is either an IDR forgiveness or a PSLF forgiveness. How is a trustee going to fight you if you say, by the way, if you allow the IDR for the next 2 years, the entire loan balance will be forgiven? Doesn't that free up money for the other unsecureds for the remainder of the Chapter 13? Yes. So the first 2 years might be painful and might be an unfair discrimination against those other unsecureds. But after that, when you get the balance forgiven, they get everything. You got to be able to do the count so you can make these arguments. I have met plenty of judges who are in favor of this. Okay. Okay. It means if you log into the student aid and it says at least one of your loans is not a direct loan, it means it's an FFEL. Okay. There's nothing for you to verify. Whatever it says in student aid report, that's what it is. Go look at the loans. One of those loans is going to say an FFEL, or it might be a Perkins. Okay. And all you need to do is consolidate. You can consolidate through studentaid.gov. You can do the applications, which I have, whatever it is. Okay. Does a borrower have to consolidate an FFEL loan that is under an IDR already, even if they only have 1 year left before forgiveness? Okay. Let's clarify. Anyone who has an FFEL is not 1 year away from forgiveness, because the only IDR they can have on FFEL is IDR, which came out in 2009, so they don't get forgiveness till 2034. So that supposition is incorrect. It can't happen. However, if they consolidate, they get the IDR account adjustment. They will get credit for payments made before 2009, and maybe that's how they're 1 year away. So yes, they must consolidate under that first one. Does a borrower of only Parent Plus loans have to consolidate? That's a great question. I know I glossed over this. If they are FFEL, yes, because that's the only way they'll get the IDR account again. If they happen to have direct loan Parent Plus, they haven't consolidated it. They just have a series of direct loan Parent Pluses, then yes, each one of those will get the IDR account adjustment. However, each one of them is on a different timetable because they took one for freshman year, sophomore year, junior year, and senior year. The senior year is 3 years behind the freshman year. If you want to get all of them on the freshman year, you got to consolidate them together. And remember, actually, I just put my foot in my mouth. They have to consolidate because that's the only way to get them onto ICR. And chances are, unless they're getting immediate forgiveness for the Parent Plus loans, the only way to get the remainder of time they need is to consolidate them and get them on ICR. Okay. All right. See, there you go. When you research and you dig, you can find out why. All right. By the way, when you read these, you will see for direct consolidation loans, you're going to see two of them. One of them is a subsidized portion. The other one is the unsubsidized portion. It is still one consolidation loan. They just chop it and sub and unsub so that they can track the end. They should be on the same timeline. And you can tell by looking at the date of origination. I'm more than happy to help you guys. I'm more than happy to help your clients. I'm not looking to steal your clients. I'm happy to be behind the curtain and help you work through this. Come to a workshop, learn how to do this, make the money. Client consolidate. Okay, here we got another question. Somebody consolidated FFEL and now they're with Navient. Navient said, oh, they lost the federal guarantee and not eligible for direct consolidation loans. Jeff, you need to email me separately. I'm not going to take the time here. This is, what's the word? Cluster. We need to talk separately about that one. And I might put you in touch directly with Department of Ed so you can work through that issue. Okay. Again, what's the deadline for FFEL? May 1st. Good. All of you have filed bankruptcies. All of you have clients already. You don't even know it. Look through all of those schedules, all of those 7s, all of those 13s. If they had a federal loan 10 years ago, they probably still have it. Get in touch with them, learn how to do this stuff, and get them moving. People will pay you for help. Okay. And if you call them and say, oh my God, I see your loan is from 1995. I've done a rough estimate on the count. You could have forgiveness right now. There you go. The May 1st deadline will apply to consolidation of a parent plus loan if it's an FFEL. My understanding is for direct loans, it's July 1st. But to be safe, I'm saying May 1st across the board. There's no reason to confuse yourself. May 1st. Just make it May 1st. There is a chance that they will delay this deadline depending on SCOTUS's response to the court case, the SCOTUS case. But for now, there's no indication that they're going to delay it. May 1st. Okay, May 1st. But you all have clients that you can help. All right. Anything else? Any other concerns? All right. Again, all the information's here. If you want to email me, jcohen@studentloanlawyer.com. If you'd like to attend a workshop, we're giving you a 10% discount to any workshop in 2023 with the promo code NC10. Go to studentloantoolbox.com for the workshop. Go to studentloantoolbox.net to learn about the software. And don't forget, next chapter. Thank you, folks, for having me and hosting this. Student loans are getting really interesting. If you have not yet registered for the webinars for tomorrow, please do so, because we're going to talk about the DOJ guidance and discharging federal student loans much easier. And after that, I'm also going to talk about how you can snap your fingers and get your client out of default with just a phone call. This is a whole new program, and it's awesome. So thank you, folks. Jeff, let me answer that question real quick. The student aid report shows 2 loans consolidated. Okay, it doesn't matter if they're consolidated or not. It matters if they're a direct loan. If it's a direct loan, it'll get the return. Period. All right, folks, feel free to email me with more questions.
Thanks so much, Josh. And thank you everyone for joining. You guys had a lot of good questions. So I'm glad Josh was able to give you all of that information and help you answer all of those questions. Like he said, if you would like to register for our upcoming sessions, we have 2 tomorrow. I posted, or Mandy posted those links in the chat function. So if you click that chat button, it's at the bottom of your screen. It should pop up into a little window at the side of the screen, and you'll see all of those links posted. So click on any of those for our upcoming sessions tomorrow, and I hope to see you all there. Thanks. Bye.